The crypto markets don't look too great. Everything is going down, and then the question remains, what are we doing with the assets that we hold? Should we continue holding, waiting for a recovery, or hoping rather that prices recover? Or should we cut our losses here? Or should we potentially even buy more? If we still have some money on the side, should we now buy this bottom? Now, if you watch 10 different YouTube channels, you're probably going to see 10 different opinions on that. What I think is important to differentiate what kind of opinion to potentially follow is, how did that YouTuber come to the conclusion? The central question is, how solid are the arguments? And did that YouTuber potentially do the right calls in the past? Right? Let's say before a bear market, did that particular person say it's time to sell? Now, here's my take on the situation. I tried to take away all the subjective judgment. I tried to make it as objective as possible using data and using statistics. And one very straightforward way to time the markets, and it's probably an approach you've seen before, is to use moving averages. So the idea is that we want to be in the market when the price is above the moving average. So for example, we take that gain from $250 all the way up to $8,000, and to then be out of the market when the price tends to decline, right? When the price is below the moving average, so we are spared from this 50% correction. This is a pretty straightforward way to time the market, and it does work to a degree. But then the question with this very simple approach is, of course, how well does it work? And is it likely going to work in the future? And is there potentially also a way to optimize this approach? Because when we look at this moving average, right? This moving average in red, this is the 200-day moving average. We would have exited the market over here, then came the COVID crash, and then we would have entered over here. But there's the first problem with that approach. When we look at this particular time in history, yes, we would have been spared from the COVID crash, but we also, wouldn't it be better if we already bought in maybe over here and we got way more of that rally? We first had to recover from the low point after COVID by 65% before buying back in. Now, one straightforward answer to this problem is to simply shorten the duration of the moving average. So let's say we don't take the 200-day, and let's say we reduce this. Then what we see is that over time, this moving average line gets closer and closer to the price action. So as I'm reducing that moving average duration, the red line gets closer and closer to the green line. And once we go to 80 or maybe to 70 or maybe to 60, right, we just have very short moving average durations. We tend to buy in much earlier after that COVID crash. So we would have sold very early. We would have avoided this crash, and we also would have bought in not after a 65% correction, but as a comparatively small 42% recovery. And so things get a bit complicated here, right? But we all do this for a reason. We do this in order to figure out a quantitative approach with fixed rules for buying and selling, something that worked in the past and that hopefully also continues to work in the future. We do not just want to rely on gut feel. We do not just want to rely on very few data points. We want to have a strategy that trades relatively frequently and outperforms buying and holding. And so now we've got two questions, right? We didn't make it easier. We've got the question, first of all, how well does the strategy work? But then also, what kind of a moving average should we take? Should we take the 30-day? Or should we take the 300-day moving average? What's actually best here? And this is where we can get help from technology. We can run back tests. So we can simulate buying and selling. We can also incorporate some trading fees into that simulation. And then we can see, had we used, say, just the 5-day moving average versus the 500-day moving average, what would have been the best? And of course, I have made that simulation. What we see here on the left is the duration of the moving average. So this goes from 2-day all the way to 200 days. So those are the moving averages I've backtested. The data set starts in August of 2017. And we see here in column C what annualized performance that moving average trading would have given us. Now, the 2-day moving average performed really, really poorly. And that's because we also include trading fees in that simulation. So 0.2% trading fees. The longer moving averages tended to perform better and better. The backtest does not just include the simple moving average, we also have the exponential moving average. And we've got a comparison for buying and holding. So over the time period of the simulation, buying and holding would have given us 28% per annum, right? So that's compounded geometrically. And so here's a virtual representation of the backtested result. On the x-axis, we've got the duration of the moving average. On the y-axis, we've got the annualized performance. In turquoise, we've got the annualized performance trading according to the simple moving average for the exponential moving average. Now, what do we see? We see that when the moving average duration is very short, that we tend to trade a lot and that the trading fees then eat up our performance. We also see that when the moving average duration is too long, that we get very close to just buying and holding performance. So we don't really outperform buying and holding if we are not reactive enough, right? The COVID example where we buy in too late. This is what happens when the moving average duration is too long. However, there is an optimum, and the best moving average is the 120-day simple moving average. That more than doubled our money every single year, 127.5% per annum for the exponential moving average. Now, what do we see? We see that when the moving average duration is very short, that we tend to trade a lot and that the trading fees then eat up our performance. We also see that when the moving average duration is too long, that we get very close to just buying and holding performance. So we don't really outperform buying and holding if we are not reactive enough, right? The COVID example where we buy in too late. This is what happens when the moving average duration is too long. However, there is an optimum, and the best moving average is the 120-day simple moving average. That more than doubled our money every single year, 127.5% per annum. It's way better than the 28% per annum for buying and holding. What's also very noteworthy is that within the 30-day to 150-day range, we tend to outperform buying and holding quite a lot. So it's not just a random walk around buying and holding, right? It's not just random. We see that in general, following the trend is a profitable strategy in crypto. If the crypto markets tend to go down, it's better to exit. When the crypto markets tend to go up, it tends to make sense to hold. So this is a real momentum play, right? The typical story is always about crypto cycles, that a few years we go up and then 1 out of 4 years we go down. We can see some cyclicality, some trend movement within the backtested data as well. Now, what does this look like? 128% per annum compared to buying and holding. The answer is in this chart. Buying and holding Bitcoin is in white. It's a small line we can barely see because it barely moves compared to the trading history of that 120-day simple moving average. The backtest starts with $1,000 and those $1,000 move to almost $200,000 during the backtest. Bitcoin buying and holding during the same time period would have given us only $4,700. Here's the same chart on a logarithmic scale. So this time the horizontal lines represent a 10x from one another, and in the end we are more than a 10x apart from one another, right? So this is the Bitcoin price, and at the top is the backtested trading performance. And we can see that sometimes we make money when prices are going down. This is because we also short the market with a leverage of 1 whenever the price is below the moving average. We can also completely remove the shorting. Then we're simply just in cash, but still we are outperforming buying and holding quite a bit. And so that's then my main approach to time the medium-term price action of Bitcoin. I believe it works very well. I've used this already for quite a long time, quite successfully as well. And unfortunately, we have fallen below this recently, right? So it's time to rather sell or bet on falling prices. Now, here's something very important to know. The approach itself works very well, right? We've seen this in the backtest, but that does not mean that the majority of trading signals actually work. I think the majority of trading signals actually are against us. They are loss makers. Because just have a look at the recent price action, right? We went below the moving average to then go above again, to go below and above and below and above. And what happens during times like this is that we buy in, right? We buy Bitcoin over here to then afterwards sell once we close below the moving average again. So we've just lost 7% here. So the simulation just looks at day end prices. We are not trading within the day. We're just trading once at the end of the day. So midnight UTC. And so we can sometimes buy relatively high to then sell relatively low. And then we go short and we bet on falling prices just to then buy back in high again and lose another 4%. So this can happen very often. This price movement around the moving average is very, very unpleasant. And a lot of those signals do get created over time. The only reason why the strategy works is that sometimes we get a clear trend. And when we do, then the trades that result from such a trend are extremely profitable. So we've got a few trades that do really, really nicely, and we've got a lot of trades that make small losses. And so with this falling below the moving average, I don't even think that we're likely going to go straight down from here. We might come above the moving average again, right? We might come above $94,000 in Bitcoin again. Just have a look at this over here. This is the relative strength indicator, the RSI. And when we fall below the 120-day SMA and we are low on the RSI can still go up. And this shows us the medium-term trading range, right? It can still go up. We are short-term oversold. Some people might buy the bottom. And then when they do, the RSI gets hotter again, we might already be above the moving average again. So whenever we are below the moving average and we are low on the RSI, there is still the risk that we're going to get a failed signal. And currently we are very low on the RSI. In other words, people have sold massively. And if now enough people buy this bottom, we could just shoot above the moving average yet one more time and we get another failed signal. And then even though this long-term performance looks nice, especially when we include betting on falling prices, betting on shorting as well. Even though this looks nice, the actual implementation of the strategy is not that straightforward. Psychologically, it can be very hard to buy high and sell low and buy high and sell low and get it wrong all the time. And that's also a problem with this channel here, right? When I say I sell a lot and then the price goes up, then everybody says that the video aged like milk. If we then afterwards go down again, nobody wants to know about that video anymore. It's also hard to short Bitcoin, right? To bet on falling prices of Bitcoin, because over the very long term, right, over the cycles, we know that Bitcoin appreciates. So betting on the hardest asset in the world to go down in price versus something as flimsy as fiat currency is not really that easy. You need to have a lot of conviction in your trading approach to bet on falling prices of something like Bitcoin. And so here's what I personally do. I don't short Bitcoin, but I do have my approaches whenever we fall below the 120-day simple moving average to make money from that. My approach is to short the altcoins, especially the very weak altcoins, because most altcoins underperform Bitcoin most of the time. 70 to 80% of altcoins do worse than Bitcoin on various time frames. On the weekly time frame, on the monthly time frame, over the year, most altcoins do worse than Bitcoin. And so when we've got an altcoin that expands very quickly in supply, where maybe the insiders are selling, where maybe the team is selling, the early investors, etc. When we see that, right, all of those vesting unlocks, then we tend to also see underperformance versus Bitcoin, and shorting those kinds of altcoins, betting on falling prices of those assets feels much easier compared to betting on falling prices of Bitcoin. But again, it's best to do this, of course, in a bear market when everything is going down. And the question is always, what's the best way to determine whether or not we are in a bear market? Here is one approach. It's one of my favorite approaches. It's just the best moving average. And as said, there are a lot of moving averages that outperform buying and holding, but there's many other approaches as well. I'm not saying that I've got the holy grail here. I'm simply saying that this approach made me money and I expect it to continue to make me money. And so this is a very counterintuitive approach, right? It lists somewhat in a niche, because in a bull market, everybody just wants to buy those small altcoins that make 10x returns. In a bear market, people tend to just go away from crypto. It's not really that common to use the bear market to make money. But again, I think it's a relatively easy way to make money because most altcoins underperform Bitcoin most of the time. So we've got the odds in our favor. When you're buying an altcoin and you hope for it to 10x, you've got the odds against you, right? Because most altcoins will not 10x. But when you're shorting altcoins, when you're betting on falling prices, you've got the odds in your favor. And so if you want to know what kind of altcoins I short, where I'm most bearish on, where I think that they will continue to underperform Bitcoin for the most time, and when you want to get a tutorial on how to do this properly directly on the blockchain, not even using centralized exchanges, then feel free to check out the premium membership over here. It's thebitcoinstrade.com. If you've still got a crypto portfolio of a few $1,000s, the fees should automatically materialize themselves. It should be cost neutral. There's also a 1-week money back guarantee. So in case you don't like premium, just message me within the first 7 days and I refund you 100%. If you got some value out of this video, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. And of course, looking very much forward to seeing you on premium as well. Cheers.